What if you invest $100,000 in the best 5 Fidelity Index Funds? Investing in index funds is one of the most popular strategies for building wealth over time. Index funds are designed to replicate the performance of a market index, offering diversification, low fees, and consistent returns. Fidelity, one of the largest asset management firms globally, offers a range of high-quality index funds that cater to different investment goals and risk tolerances. In this video, we'll explore what would happen if you invested $100,000 in the best 5 Fidelity Index Funds. We'll examine the performance, benefits, and growth potential of each fund, focusing on how they can help you achieve long-term financial goals. Why Fidelity Index Funds? Fidelity is known for offering some of the most affordable and accessible index funds in the market. With low expense ratios and no minimum investment requirements for many of its funds, Fidelity makes it easy for investors to diversify their portfolios and benefit from long-term growth. The advantages of Fidelity Index Funds include low fees. Fidelity's index funds often have some of the lowest expense ratios in the industry, which can significantly boost returns over time. Diversification. By investing in index funds, you gain exposure to a wide array of stocks, reducing the risk associated with investing in individual companies. Simplicity. Index funds require less active management, making them ideal for long-term, passive investors. Reliable performance. Index funds aim to mirror the performance of a specific market index, providing steady and predictable returns. Now, let's explore the best 5 Fidelity Index Funds and the potential outcomes of a $100,000 investment spread across them. 1. Fidelity 500 Index Fund, FXAIX. The Fidelity 500 Index Fund, FSXPX, is one of Fidelity's most popular funds. It tracks the performance of the S&P 500, which includes 500 of the largest U.S. companies across various industries. The S&P 500 is widely regarded as one of the best indicators of the U.S. stock market's overall health. Expense ratio, 0.015%, extremely low. 5-year average annual return, approximately 10-12. Why it's a top pick. The Fidelity 500 Index Fund offers investors broad exposure to some of the most successful and stable companies in the U.S., including tech giants like Apple, Microsoft, and Google, as well as industry leaders in healthcare, finance, and energy. Potential outcome. If you invest $20,000, 20 of your $100,000 in FSXPX, and the fund continues to generate an average annual return of 10%, in 10 years, your investment would grow to approximately $51,875. Over 20 years, it could grow to around $134,550, assuming the same average return. This growth is driven by the stability and consistent performance of large-cap U.S. companies, making FSXPX a solid foundation for any long-term portfolio. 2. Fidelity Total Market Index Fund, FSXPX. Fidelity Total Market Index Fund FSXPX is designed to track the performance of the entire U.S. stock market, including small, mid, and large-cap companies. This fund gives you broader exposure than the S&P 500, making it a great option for investors seeking full market coverage. Expense ratio, 0.015%, very low. 5-year average annual return, approximately 9-11. Why it's a top pick. FSXPX offers more diversification than the S&P 500 fund, as it includes thousands of companies of various sizes across all sectors of the U.S. economy. This wider exposure can help mitigate risk and capture growth in different market segments. Potential outcome. A $20,000 investment in FSXPX, assuming an average annual return of 9%, would grow to about $47,500 in 10 years and approximately $121,900 in 20 years. The broader exposure to small and mid-cap stocks, which have higher growth potential, can lead to slightly higher returns than the S&P 500 over long periods. FSXPX is an excellent choice for investors who want comprehensive exposure to the U.S. stock market without having to pick individual stocks. 3. Fidelity NASDAQ Composite Index Fund, FMCX. The Fidelity NASDAQ Composite Index Fund, FMCX, focuses on companies listed on the NASDAQ stock exchange, including many of the world's leading technology companies. This index is more tech-heavy than the S&P 500, offering investors higher growth potential but with slightly more risk. Expense ratio, 0.29. 5-year average annual return, approximately 15-17. Why it's a top pick. The NASDAQ is home to some of the fastest-growing and most innovative companies globally, including tech giants like Apple, Amazon, and Tesla. FMCX provides exposure to these high-growth companies, making it ideal for investors with a higher risk tolerance who are seeking significant growth potential. Potential outcome: a $20,000 investment in FMCX with an average annual return of 15% would grow to approximately $81,370 in 10 years and around $330,000 in 20 years. The higher growth rate reflects the rapid expansion of technology and consumer-centric companies that dominate the NASDAQ. However, it's essential to note that the NASDAQ can be more volatile than broader market indices, so investors should be prepared for short-term fluctuations in value. 4. Fidelity U.S. Bond Index Fund FXNAX. The Fidelity U.S. Bond Index Fund FXNAX tracks the Bloomberg Barclays U.S. Aggregate Bond Index, offering broad exposure to the U.S. bond market. Bonds are generally less volatile than stocks, providing a stable source of income and helping to reduce overall portfolio risk. Expense ratio: 0 to 5, 5-year average annual return, approximately 3.4. Why it's a top pick: bonds play a crucial role in diversifying a portfolio and providing stability during periods of stock market volatility. FXNAX is an excellent choice for conservative investors or those nearing retirement who want to reduce risk while still generating returns. Potential outcome: a $20,000 investment in FXNAX, assuming an average annual return of 3.5%, would grow to about $28,240 in 10 years and around $39,700 in 20 years. While bond returns are lower than stocks, they offer essential downside protection and income stability, especially during economic downturns. Including a bond index fund in your portfolio ensures a balanced approach that aligns with Buffett's famous advice: never lose money. 5. Fidelity International Index Fund FSPXX. The Fidelity International Index Fund FSXPX tracks the performance of developed markets outside the U.S., offering exposure to companies in Europe, Japan, and other international markets. International investments provide diversification by spreading risk across different economies and regions. Expense ratio: 0.035, 5-year average annual return, approximately 7.9. Why it's a top pick: investing in international markets can help hedge against risks specific to the U.S. economy and provide access to growth opportunities in other parts of the world. FSXPX includes a mix of large, established companies that can offer steady returns. Potential outcome: a $20,000 investment in FSXPX, assuming an average annual return of 8%, would grow to about $43,180 in 10 years and around $99,370 in 20 years. International diversification is essential for long-term investors who want to reduce exposure to a single country's economic fluctuations and capture growth in global markets. The power of diversification. By spreading your $100,000 across these 5 top-performing Fidelity Index Funds, you create a diversified portfolio that taps into the growth potential of different sectors, asset classes, and regions. Here's how a $100,000 investment might perform over time, assuming the average annual returns mentioned earlier. FSXNAX S&P 500 Index Fund, $134,550 in 20 years. FSXNAX Total Market Index Fund, $121,900 in 20 years. FMCX NASDAQ Composite Index Fund, $330,000 in 20 years. FXNAX U.S. Bond Index Fund, $39,700 in 20 years. FSXPX International Index Fund, $99,370 in 20 years. Total portfolio growth. 10-year projection. If each fund performs as expected, your $100,000 investment could grow to approximately $246,165 in 10 years. 20-year projection. In 20 years, your investment could grow to an estimated $725,520, demonstrating the power of compound interest and a well-diversified portfolio. Conclusion. Investing $100,000 in Fidelity's best index funds is a powerful strategy for building long-term wealth. By choosing a diversified mix of funds ranging from the S&P 500 and total U.S. market to bonds and international equities, You gain exposure to different asset classes, reducing risk and enhancing growth potential. With low fees, reliable performance, and the benefits of compound interest, Fidelity Index Funds provide an accessible and efficient way to grow your wealth over time. While no investment is entirely risk-free, a diversified portfolio of index funds is one of the safest and most effective strategies for long-term financial success. With patience, discipline, and the right mix of investments, your $100,000 could potentially turn into a substantial nest egg over the next 2 decades.